Welcome to Finance Empire. Liquidity is one of those concepts that sounds simple, but it is absolutely essential to understanding finance and markets. In everyday life, liquidity refers to how quickly something can be turned into cash without losing value. Think about your checking account. You can access money instantly. That is perfect liquidity. Now, think about a car. If you need to sell it immediately, you might have to accept a lower price than it is worth. That's less liquidity. Liquidity is not just about cash. It is about how fast, easily, and reliably an asset can be converted into money. The more liquid an asset, the easier it is to use it to buy, sell, or trade. Liquidity exists at multiple levels: individual, corporate, and market. For individuals, it is about having enough cash or easily sellable investments to meet daily needs and unexpected expenses. For companies, it is about having the resources to pay suppliers, employees, and debts on time. For markets, liquidity means that buyers and sellers can trade assets without causing big price swings. Markets with high liquidity are efficient. Prices reflect reality, transactions happen smoothly, and investors can move in and out without large losses. Markets with low liquidity are risky. A sudden sell-off can cause sharp price drops and panic. Liquidity also comes in different forms. There is cash liquidity, which is the most immediate and secure. There is market liquidity, which refers to the ability to buy or sell assets like stocks, bonds, or commodities. And then there is funding liquidity, which is the availability of money to borrow, like loans or credit lines. Why does liquidity matter so much? Because even the best investment loses value if you cannot sell it when you need to. Even the strongest company fails if it cannot pay its bills due to lack of liquid resources. Today, we will explore all aspects of liquidity. We will look at how it affects individuals, companies, markets, and the global economy. By the end of this video, you will understand why liquidity is the lifeblood of finance. Let's dive deeper into market liquidity. Market liquidity is the ability to buy or sell an asset quickly without affecting its price too much. Highly liquid markets, like the stock market for large companies, allow trades to happen in seconds. Less liquid markets, like rare collectibles or small company stocks, may require days or weeks to find a buyer. Liquidity is influenced by several factors. Number of participants. More buyers and sellers equals more liquidity. Volume of trades. Higher volume equals easier transactions. Transparency. Clear pricing equals more confidence and liquidity. Regulations. Smooth rules equals higher trust and liquidity. Liquidity is also a dynamic concept. During calm periods, markets can feel very liquid. During crises, even normally liquid markets can dry up. Take the 2008 financial crisis, for example. Banks were unwilling to lend. Markets froze, and assets that were normally easy to sell suddenly became almost impossible to trade. This is called a liquidity crunch, and it can have devastating effects on prices and confidence. Assets themselves have different levels of liquidity. Cash is king. Treasury bills and government bonds are extremely liquid. Stocks in large companies are generally liquid, but small-cap stocks can be less so. Real estate is illiquid. It can take months to sell a house at a fair price. Private equity, collectibles, and art are even more illiquid. Liquidity is not free. More liquid assets usually offer lower returns because they are safer and easier to sell. Less liquid assets often promise higher returns as a reward for the risk of not being able to sell quickly. This brings us to liquidity premium, the extra return investors demand for holding illiquid assets. Understanding this concept is key to portfolio construction, corporate finance, and market behavior. Liquidity also interacts with volatility. Illiquid assets tend to be more volatile. If a small number of investors try to sell at the same time, prices can swing dramatically. Liquidity cushions markets, reducing dramatic movements and panic selling. So far, we have explored individual assets and market liquidity. Next, we will discuss liquidity for companies and financial institutions. For companies, liquidity is critical. A profitable company can still go bankrupt if it does not have enough liquid resources to pay bills or debts. This is called a cash flow problem. Liquidity management is therefore essential for corporate survival. Companies measure liquidity using ratios. Current ratio, current assets divided by current liabilities. Quick ratio, liquid assets excluding inventory divided by current liabilities. These ratios help determine if a company can meet short-term obligations. Banks and financial institutions have an even more critical role in liquidity. Banks take deposits and lend them out. If too many depositors withdraw money at once, the bank can face a bank run, even if it is fundamentally solvent. This is why central banks act as lenders of last resort, providing liquidity to stabilize the system. At the macroeconomic level, liquidity drives economic activity. When liquidity is abundant, companies can invest, households can spend, and markets function efficiently. When liquidity dries up, recessions can accelerate, credit freezes, and the economy contracts. Liquidity is also a strategic tool for investors. Having liquid assets during crises allows you to buy opportunities at lower prices. Illiquidity can trap you in losing positions or prevent you from taking advantage of market dislocations. Finally, liquidity is interconnected globally. Global markets rely on capital flows between countries. A liquidity shortage in one major market can ripple across the world. This was evident in the 2008 crisis and during sudden market shocks like the COVID-19 crash. In conclusion, liquidity is more than cash. It is the ability to act, react, and survive in a financial system. It affects individuals, companies, markets, and entire economies. Understanding liquidity means understanding stability, risk, and opportunity in finance. Closing. Thiso. ... Subscribe to Finance Empire for more financial knowledge.